Hey traders, today we'll be going over a simple 5-minute time frame scalping strategy that anyone can implement into their trading. We'll also be covering a step-by-step method to help ensure you're taking high accuracy and high probability scalping trades. Let's get started. So first, what is scalping? Scalping is a style of short-term trading that is popular among many traders today. It involves placing a trade and then holding on to it for only a short period of time in an attempt to make a profit. This style of trading is very different to how a day trader or swing trader would trade, as they will tend to take less trades and hold on to them for a greater amount of time. A scalper, on the other hand, would look to make a large number of trades, often in a short period of time, and take advantage of the small movements and fluctuations of price that happen throughout the trading day. In this chart example, we're looking at a daily chart of the dollar Canadian. A trend-following trader would not have much opportunity at this point in time as price is stuck in a range. The range top is contained by this level here, and the range bottom is contained by this level here. The trader would have to wait for price to break outside of this range in order to have a trade opportunity, which eventually comes in here. However, if we zoom in on this exact chart to a 5-minute time frame, we will see that the scalper has many opportunities to take trend following trades. Here is the exact same chart we were just looking at of the dollar Canadian, except now we are looking at it from a 5-minute time frame rather than a daily time frame. As you can see, there are multiple opportunities for scalping trades on this time frame, despite price being stuck in a tight range on the daily chart. Let's cover the first trade opportunity. Here is the range bottom we were looking at on the daily chart just a moment ago. As you can see, the level held as good support on the first touch. We saw a bullish reaction, and then price traded sideways for a short while. Then, what we saw next is referred to as a trap trade. This is where price rapidly moves in a certain direction with the intent of trapping traders in a losing position and then forcing them to exit their trade as price goes the opposite way. We see a number of red candles in a row with price looking very bearish. We break below the previous swing low with breakout traders placing sell trades as price goes lower. There's just one problem. This time, it was a trap. Price quickly reverses in the bullish direction, and all of a sudden we're back above the level we just broke below. All the breakout traders who sold as price moved down are now stuck in a losing position and are forced to exit their trades as price continues higher. The best trade opportunity here comes in the form of a retest of the key level. An entry place here would allow us to use a tight stop loss at the previous low. This is an excellent scalping trade, where we are able to profit from other traders being trapped in a losing position. The second trade opportunity comes in the form of a simple trendline touch. Price has reversed off the key level we were at just a moment ago and has just broken an intermediate swing high. This now puts us in a position where price is making higher highs and higher lows, so we would be on the lookout for a buy trade. Drawing a trend line so that it's touching these 3 points here would allow us to enter the market on a simple touch of the trend line, which comes in here. Price then continues making higher highs and higher lows as the bullish trend continues. The final trade opportunity comes in the form of a simple buy trade off of support. We had a strong level of resistance here previously. Price touched it 1, 2, 3, 4 times before it was able to finally break through. A key concept to remember here is the following. Once price breaks through a level of resistance, it can often act as support when we return to that level. So we wait for price to return. As price reaches the level, we see a sharp decrease in momentum. We see 3 small red candles immediately followed by a large green candle. This is good confirmation for us to place a buy trade with a stop loss just below our level of resistance turn support. Before long, price goes on to make a new high for the day. This was an excellent low-risk scalping trade, taking advantage of a strong support level. What advantages does scalping have over other styles of trading? The first advantage is that it's great for traders who don't have a lot of time available to trade. If they are focused, a scalper can get their entire day's worth of trading finished within an hour, ensuring they are taking high probability trades. Looking at this chart, an hour of trading time takes place in this entire area. As you can see, there were multiple price action trade opportunities within this period of time for the scalping trader who was alert for trade setups. However, there's one very important concept we have to keep in mind. As a scalper, the time of day that you trade is of the utmost importance. We recommend trading during the London and New York Open session times. These times are when the markets are the most volatile and most liquid, which is a perfect trading environment for a scalper looking to take some quick trades. The second advantage of scalping is that it often requires less mental discipline. Many traders find it difficult to hold on to trades for hours or even days. They become impatient. It's very easy to get scared out of a trade when it's been going against you for a long period of time. It's even easier to feel tempted to close a trade prematurely before it hits your profit target. With scalping, the trade can often be over within a matter of minutes, meaning that for many traders, less discipline is required when they adopt this style of trading. The third advantage of scalping is that it does not require price to be trending in order for the trader to make money. Many people identify themselves exclusively as trend traders. There is nothing wrong with this, but it can lead to problems when their favorite market is stuck in a non-directional trading range. In this scenario, they would have to wait for price to break out outside of the trading range before they will have a trading opportunity. With scalping, this is a non-issue. Even the smallest trading ranges on the daily and weekly charts will contain micro trends on the 1 minute and 5 minute charts, which a scalper can take advantage of. It's time to run through a step-by-step strategy for scalping. Step 1 of this strategy is to load up a 1 hour chart of your favorite product. We are going to use this chart to find higher time frame key levels, which we will then be able to scalp around on the 5 minute chart. Here, we have an hourly chart of the pound dollar. Let's draw in our first key level, which we will use on the 5 minute chart for our scalping strategy. You can see this level was respected multiple times by price. Now, let's draw in our second key level. Now that we have our higher time frame key levels drawn in, we can now switch over to the 5 minute chart for step 2 of this trading strategy. Here's a 5 minute chart of the pound dollar, with our key higher time frame levels already drawn in from earlier. Step 2 of this strategy is to identify a price action trade entry on the 5 minute chart. In the first trade opportunity, we can see that price was consolidating below the higher time frame key level. The candles are small and there is very little momentum in the market. Then, we see price expansion as we head up towards our key level. Price rejects this level on the first green candle that touches it, as seen by this candle wick that was left behind. The next candle is a strong red candle, closing lower than the previous candle. This is a good confirmation that sellers are in control, and so we will look to take an entry on the close of this 5 minute candle. To get an even tighter entry on this trade, we can even switch to the 1 minute time frame and look for a price action pattern entry. Here's a 1 minute time frame of the pound dollar in the exact trade location we're just looking at on the 5 minute chart. Here's the higher time frame key level. Here we can use a level of resistance on the 1 minute chart to get a great trade entry. You can see the level of resistance forming here as we approach the higher time frame key level. Price went up and touched the higher time frame key level and then rejected down. Then we closed below the level of resistance on the 1 minute chart here. We would use this as our trigger to enter the trade. Price then consolidates for a handful of candles before finally pushing down as strong bearish momentum comes into the market. In the second trade opportunity, we can see that price was heading directly down to the next higher time frame key level. Again, we get a rejection of this level as a candle wick forms on the red candle that touches it. The very next candle is a bullish engulfing candle, which is a green candle that completely covers the previous bearish candle. This is a good sign that buyers are in control, and we would look to take an entry on the close of this candle. Again, to get an even better entry on this trade, we could switch over to the 1 minute time frame and look for a price action pattern entry. Here is the 1 minute time frame in the exact trade location we're just looking at. Here's the higher time frame key level. We can see that on this time frame we had 2 attempts to break below this key level. The first attempt comes in here, and the second attempt comes in here, only able to get slightly below the previous selling attempt. This is what's known as a double bottom, and as price closes higher on this strong green candle, we would look to take a buy entry. Step 3 of this strategy is going to be your trade management. There are 2 ways we recommend managing your trade. The first is to close the full trade position as price reaches a lower time frame level of support and resistance. So for the first trade, we would look to close the full position as price reaches this level of support. And on the second trade, we would look to close the full position as price reaches this level of resistance. The second way to manage your trade is to close 50% of your trade position when price reaches a level of lower time frame support or resistance, and then hold the other 50% for a larger target. So for this example, in the first trade opportunity, we could look to hold 50% of our trade position for a larger move to the other higher time frame key level. If price is unable to travel that far, then we would close the rest of the position before price returned to our entry level.